Hello, Dynamic Directions. Welcome to the fourth quarter, and the next time I'll be seeing you, you better have your 10-gallon Stetson on and some fine cowboy boots, because we'll be in Austin, Texas. Yeehaw. But before then, let's talk about where we are with the market. As we come into the end of October, the S&P has made an all-time high just yesterday as we tape this. Risk assets, especially higher quality, larger stock risk assets, appear to be performing well. Some of the fear and anxiety around the U.S.-China trade relations and that deal has abated, and we've seen stocks really have an uptrend generally most of the month of October. Nothing is signed with the Chinese, but still it looks like the path has been created that we can get some type of détente with them. I don't feel like a comprehensive agreement will be reached, but I think it's going to be good enough where both parties can kind of hold their nose and sign, as they say on Wall Street, and go on with life moving forward. What does the world look like post this U.S.-Chinese trade agreement? Well, it probably looks a little bit like it did before, but the real winners longer term will be some of the peripheral countries around China and in the emerging market, that more and more larger businesses will shift production activities to that warehouse in China. I think it's clear that there has been a dearth of announcements with regards to large companies like Apple or Microsoft locating any type of new facilities in China in the last year and a half since the trade war really kicked off in February of 18. And I think more and more announcements are centered on some other countries such as India, Vietnam, Malaysia, the old Burma, South Korea, etc. Some of those countries are going to have to invest billions of dollars in infrastructure to really create the system that can get whatever is being manufactured from the manufacturing facility to the port with a gantry crane, loaded on a huge container ship, and out to sea safely. These are, say, 5 years to 10 years construction projects. So there are opportunities accordingly along with that for companies that specialize in this type of heavy construction, and especially within the emerging markets in general. So that's one part of the market that I think will react pretty well once we get a Chinese deal halfway finished. The other part of the market that has done really well in the last month have been financial stocks. If any of you are shareholders in financial services companies, you've probably seen that with the stock price hitting new highs or recent highs just in the last few weeks. It does appear that as rates really fell in August, especially banks didn't follow rates down that low on the loans they were issuing, and they've still maintained a comfortable credit spread between what they pay in depositors and what they take in loans. Other financial services businesses have followed suit. The media has really focused on this zero-sum game where Schwab and some other online brokers and Fidelity are saying no commissions. I know clients ask, how does that work? You have to get into a lengthy discovery process with them about where brokerages really make their money with cash on the sidelines, shares, etc. But generally speaking, the bottom lines of most of the companies that have reported have been very positive. Also, tech earnings have been a little bit somewhat skewed. Amazon, which is kind of quasi a tech company and consumer discretionary spending company, their earnings disappointed a bit. The stock's kind of trading in the middle of its range right now, but they are really reinvesting in their distribution channel. Anecdotally, anytime you're out on the road, especially on the interstate system, you can probably see some Amazon Prime trucks on the road. We noticed, half a dozen or more just this last weekend here in Middle America. Another area that's been a little bit stale has been energy. Depending on the day of the week and the news flow, oil prices can fluctuate, but generally crude oil has stayed around the mid-50s. Gold seems to be found a new trading range a little bit higher than where it was a year ago. It hasn't really flashed very high over $1,500 an ounce, but still we're comfortably probably 15 to 20% higher than we were 12 months ago in the price of the precious metal. Finally, with fixed income, we remain kind of committed to very high quality short-term fixed income. In our minds, the risk rewards of what can go wrong versus what can go right are better to be safe than sorry with that piece of the portfolio. If you're taking more credit risk, just be aware of where we are in the credit cycle, especially with people lending to commercial real estate ventures. I think any halfway large city you can go through and spot probably double digits the amount of cranes along the skyline as more and more building goes in. The question is how are people and where are the people going to come from for those apartments and offices? So right now we're relatively in a risk-on mode. We've continued to take a little bit of a more conservative stance as the year has gone on, taking profits. The election year typically is volatile. We will see what happens on the other side of the ticket from Trump and whether or not any additional Democratic candidates come into the mix, or if it's going to be really a Elizabeth Warren-Biden showdown as the primary season goes on. That's where we are as of today. We look forward to seeing you in Austin, and until then, have a great month. Hello, Dynamic Directions. Today's topic is going to be talking points with clients who want to talk returns, but really aren't grounded in the reality of what a diversified portfolio looks like. If many of you are like me and have a long tenure in the business, it's not uncommon to have clients, especially in this stage of the investment cycle where it looks like we've hit new highs several times during the year, contemplate why their fully diversified portfolio isn't up X% because they saw in the nightly news that the stock market is up X%. I think it's very important that at least twice a year you have a very good discussion with your clients to show them in a macro level what they're investing in. How much of it is bonds, and describe what bond-like returns are. How much of it is cash and why they have cash and what cash type returns are. How much of it is alternatives and what alternative returns typically are. And then finally, how much of it is stocks. Generally, clients only see the stock pieces because they follow either the nightly news or whatever app that they have on their mobile device that shows them the market hit a new high and everything's great. But really, what they miss time in and time again is that most diversified portfolios, especially for those retired, have many other aspects than just stocks. So here's a couple of tools that we use here that can kind of help put things in perspective. Number one, if you have clients that are still working, chances are that their retirement plan is either at Vanguard, Fidelity, or T. Rowe Price. All three of these providers have their versions of asset allocation funds or time to retirement funds. Make yourself very acquainted with what type of performance and how they're allocated, which is more important. So to sit down with your clients and show them at work, this is how you're allocated, and here is how you're allocated with me. Here's how they are complementary to each other, or here's how maybe they're non-complementary to each other. Make all your discussions around this centered with that as the basis and the foundation. After many years, this will sink in, and people will begin to understand there's more to it than just stocks. You can find this information obviously in Morningstar or even most websites. For example, we do track quarterly how Vanguard's doing with their allocation models versus how we do things. Also iShares, and then we use a loaded fund companies actively managed funds as a way to look at that as well. One thing that's interesting, if you can be totally transparent, which we recommend in showing your clients these different methods, that will help it sink into them when they see what the market is doing. They look at their own portfolio in a different way, realizing they have many components to this. We have resources we can help you with. You can obviously call in. We'll be happy to do that. You know where your clients work, so you take it upon yourself to get an idea of what are the top 3 to 5 holdings in each 401k plan, so you can get a better idea, and what are the time to retirement or asset allocation holdings there, and be upfront and show them where they are from an asset allocation standpoint. Typically, performance issues really aren't performance issues, they're allocation issues. And if you share that with the client to make sure their allocation is tied to their risk posture, you should have a very, very good and fruitful client experience. Thank you, and see you next month.